This is William Richardson, the original money doctor, the voice of reason, with the financial checkup and question of the day. I have my daughter with me here again, Esther. Esther, how are you doing today?
Hi, Dad. It's great to be with you.
Awesome. So what's the question of the day? I'm excited to hear that.
The question of the day comes from emails, messages, callers, and personal contact. Today's question is executive benefits and tax savings.
Oh, I love that. Executive benefits. That's where I get to help business owners, all the hard work that they put into and help them pay less taxes. So that's going to be a fun one.
Okay, I'm eager to hear all about it.
Thank you, Esther. Our question was executive benefits and taxes. So I'm pretty sure what they want to get at here is what kind of executive benefits. And in financial planning, when we're talking about executive benefits, it's generally related around a key executive for a company. That could be a corporation or a sole proprietorship or a key executive for a business owner. Now, typically what we're doing is, as key insurance, is we're going to a insurance corporation and we are leveraging money that the corporation has to purchase an investment, an insurance policy for that employee to give them additional income in retirement. Now, there's a lot of ways to do that. We can do premium financing, which means we're going to an outside entity and actually borrowing the money to fund this contract. Or the corporation is taking the money out of the proceeds of their revenue that they have. And then also we have an opportunity for the business to pay the taxes for the employee. And it's typically what we try to put it together that it works that way. So the employee has the full benefit of their money growing tax-free. Because once again, what do we have to do with all of our money? We have to pay tax at one point. And if we're going to put our money into a properly structured executive bonus plan that is tied to an insurance contract, and typically we're using an indexed universal life contract to allow all the upside potential and none of the downside risk, but have the opportunity to collateralize and borrow and have that money loaned to us for various reasons. And one of them that we really like and is really interesting that the IRS code allows us to do is for the corporation as the executive. Now, let's say, for example, you're a small business owner and it doesn't really matter how many employees that you have, but it's a closely held corporation. So you're an employee of the corporation and you're going to give yourself a benefit from the profits of the corporation. And let's just say it is $100,000. So you can pay yourself $100,000 and you're going to cover, the taxes. So you throw another $50,000 in there to cover the taxes. So it's $150,000 net the taxes. You get your $100,000 to fund your retirement program for that particular year, or the entire amount, whatever type of how big the contract's actually going to be. Well, let's just say you're putting $100,000 a year into the contract from the proceeds of the corporation. What that allows you to do is come back and become your own banker. But then since you are the banker and you're also tied to the corporation because you have an interest in both of them, and your corporation needs to purchase something, whether that be a piece of equipment that it needs. Let's say, for example, that you are actually in the medical field and you need to purchase a piece of equipment that happens to cost, $65,000, $100,000. You're going to borrow from your side fund, which is your properly structured vehicle that you have, your executive bonus program, and you're going to borrow that and you're going to loan that to your corporation. Now, what does your corporation have to do? If it borrowed money from anybody else, what is it required to do? It's required to pay it back, over time. So now you're making money from your retirement program here, which is your executive benefit program. As you borrow it, you actually make money in the contract when you're borrowing it. Then you're loaning it to your corporation. Corporation's going to pay you back interest. What interest? Interest that you decide. Are you going to charge them 2% or 10%? That's all up to you what you want to charge them. Then what happens to the corporation? Well, the corporation gets a tax write-off on both sides. You, as the individual, as the banker, you get an opportunity to gain potential from loaning the money, from the spread that you're making. You also get the spread from the difference in the investment. So it puts you in a very good situation as being in control of that money and controlling both entities. And let's say, for example, that you have employees that are not tied to the corporation. They're just key employees, and you want to have a plan for them that actually the corporation is actually going to own this time, because they're very valuable to you. Why would they be valuable to you as a company? Well, you pay them $150,000 a year, $300,000, $50,000, and they produce more income for you than what you're paying them. If they were to leave, it would be a hardship for your corporation to make up the difference from the sales that they bring into your company. So you have a key man insurance policy with them that would cover the losses for you if something were to happen. And that can also be tied into an executive bonus program that in the future, as they left and everything worked out, that they would have that benefit to go to the corporation and also go to their family if something were to happen to them. So we have an opportunity to use an executive benefit program that capitalizes and benefits us on taxes. Now, there's other ways to fund executive benefit programs. There's also more taxes that are involved. There's also more liability on upside potential. And what are we always looking at? Are we trying to get the highest rate of return, or are we trying to get a consistency over time of a fair rate of return and let compound interest work? Because we're not looking for a get-rich-quick scheme, are we? If you're looking to have your money work instantly, then what are you going to do? You take money from where? So we go back to the 10-80% rule. First 10%, we give it away to our favorite church or charity, whatever that means to us. So money is not control to us. Money is not the root of all evil. It's something that we use as a tool to benefit our life and society. Second, we pay ourselves first, because we know there's never going to be any money at the end of the month, either to pay ourselves, or if we don't pay our corporation, we always have to have money there. And third, we lay off 80%. So if you want to be in risk, we really want you to go and look at that 80% first and take your 10%, 20%, 30% off of that to put that money into risk. But always allow your 10% to grow in a safe vehicle where you have upside potential, no downside risk, fair rate of return. But what's most important? Taxation. That we have ability to pay the tax on the seed, the farmer story, penny story, and allow that money to continue to grow over time, collateralize it, borrow from it, but not touch it. Be our own banker. Do what large corporations do. Do what banks do. Do what some of the smartest money managers have been doing for years. And what is the opportunity? What does an insurance company do? What is their number one responsibility? Their number one responsibility is to mitigate risk. And if that's what they do, if that's what they specialize in. So if you're going to go into the hospital to have surgery, do you go to someone that's a generalist, or do you go to someone that's a specialist? You go to a specialist because you know that they have been spending time and they're very good at what they do, and that's all that they do. And so that's what the type of insurance companies that we work on, these type of financial planning, that's all that they do is mitigate risk. And another thing that's very interesting is if you look into how they're capitalized. On the surface, if we look at a banking institution, when they take in $1, they're only holding on to 30 cents on the dollar. When you go to an insurance company, they actually have to take on 100% of the dollar, and actually goes into what's called their general fund. So when they go out and do investments, where they're buying options or other type of investments or bonds, whatever they're actually investing in, they do that from their own money. So they're never putting out the risk of the money that they're taking in, which allows them at any time to pay off all their depositors or all their investors at any one time. Now, can your average bank do that? They can't. They don't have the money there. Let's say you have $40,000 in your bank account, and you go there tomorrow and you knock on the door and say, I want my $40,000. They're going to tell you have to come back another time. They don't have your money. It's actually stored someplace else, and they're reinvesting that. And we'll actually go back into another topic another time that we get deep and down into that. But if that's an interest to you of how banks work and how the dollar works and what's happening across the world, go and read the World Economic Report. Dive into that and you'll learn a lot of information on that. Let's go back and go from the top. So let's go back and just kind of wrap everything up. Executive bonus program. What we're looking for is a good opportunity where the money's being stored, how it's benefiting the corporation, especially if it's a closed-held corporation, and the executive. Become your own banker, have the opportunity to take the money from the corporation, let it grow, loan it back to the corporation. Corporation pays you back that money, and it's very simple. It's actually very clean, and the biggest thing about it is there's really no red tape and there's no governments controlling this transaction. It's very clean. You'll like it. Take a look at it. And with that said, keep your money safe.
Living with purpose and real intent. If you're as concerned as I am, and you're not the type to sit around and wait for something to happen, there's something you can do. A special gift invitation. How to get growth, protection, and income for your money. Send a request for a special promo code to watch this new online video training series absolutely free in the comfort of your home or office. You will learn how hard-working American families protect and control their retirement money and never expose it to stock market risk or massive taxation. Watch this free video series and learn the rules. Send requests to info@citizensfinancialsecurity.com. That's info@citizensfinancialsecurity.com to view video online. Video series is shared as a public benefit for enlightenment.
This is Esther Richardson, and you're listening to The Original Money Doctor with the financial checkup of the day. Ask about our educational, private, and public online seminars, video series, and live broadcasting events. Visit the event calendar at moneydoctoradvisor.com.
You've been listening to The Original Money Doctor, inspiring you to rise above it all and plan ahead with guaranteed success. William F. Richardson is The Original Money Doctor.